What the heck is going on with these advertising giants? So Alphabet plunged by 9.5% post-earnings, and right after Meta reported their earnings, Alphabet, which is Google, dropped another 2.3% in the after hours. Meta, on the other hand, fell 4% pre-earnings and had another 3.3% slide down post-earnings. So investors are probably wondering if this is something they should be concerned about. So this is the TLDR, too long didn't read. So let's start with some of the high-level numbers for Alphabet. So they reported strong numbers, both sales and profit actually topped the estimates of Wall Street. 11% revenue growth, which was a strong rebound from last year's 6% growth. Operating margins were trending nicely from 25 to 28%. So zooming into the business segments, their search business actually grew by 11%, YouTube ads grew by 12%, but Google Networks, on the other hand, shrunk by around 2.5%, where they cited economic softening and also an increased competition from TikTok. So Google Network makes up roughly around 13% of their advertising revenue. So this shouldn't pose a large concern to many Alphabet investors. So the kicker comes in when you look at the cloud segment. So Google Cloud specifically, it grew 22% year on year. So some of you will be scratching your head, thinking why Google's share price would tank by more than 10% when one of its key segments had grown by 22%. It's 22% we're talking about, not 2%. But look at this CNBC headline. It essentially summarizes everything. Alphabet shares drop as cloud miss overshadows better than expected overall results. So let's put this cloud miss into perspective. So 22% looks good alone, but it doesn't give us the full picture. So if you contrast this with the other big boys in the industry, Microsoft grew Azure at a 29% clip, despite being 2 times the size of Google Cloud. In short, the story for Google Cloud is slowly losing its appeal because many investors initially thought that, hey, Google, armed with its suite of legacy products, is able to easily convince potential customers or prospects to adopt their cloud services and network, fighting off the big boys like Azure and Amazon Web Services. As of the time of this recording, Amazon is slated to report their earnings tomorrow, and we shall keep our eyes peeled on what is to come. So if AWS also significantly outperformed the growth of Google Cloud, I think it will be 2 tight slaps on Google's face. So do you know how to save Google from this embarrassment? Of course, it's by smashing that cute little like button so that they can boast on their user engagement metrics. So they might fall short on cloud, but their video sharing platform is one of the best in the world. So another reason behind this stark contrast in growth is the 2 inherent advantages both Microsoft and Amazon enjoy, namely scale and network. So on scale, as Microsoft and Amazon have started building their cloud ecosystem from a very early and young stage, so many developers are accustomed to the language and the operating system of the big players. So this inherent stickiness actually generates a level of resistance for people having to unlearn and relearn an entirely new system. So this is very much similar to Adobe's current position in the creative industry. So some might argue that, hey, some of Adobe's products and platforms really suck as they keep crashing, but they're still the industry standard. And the switching cost is too high for professionals and companies alike. So on network, Microsoft is able to tap into their advantages of offering clients a bundled package of their products and services, including Azure. So this bundling effect has enabled them to overcome the pressure from video conferencing platforms like Zoom, professional messaging platforms like Slack, etc. So cloud in this case will be no exception. However, let's not forget that Alphabet is still an advertising company. They derive nearly 90% of their revenue from their advertising business. And although their cloud offering tells a very good growth story ahead, we should not forget where the money printer is. But judging at how the market reacted after looking at their earnings, I thought for a moment that Google was a cloud company, not an advertising company. That said, I do have something to share based on my own personal experience in the cloud space. So especially in this extremely volatile environment, many companies cannot afford to risk concentrating their business on one choke point. So diversification is the theme for the coming decade, regardless whether it's on a country level or on a business level. And the cloud industry, they're no different. So many companies that I know of actually adopt a multi-cloud approach, and addresses different business needs with the best solution out there in the industry. Therefore, I believe that as long as Alphabet continues putting in investment and efforts to develop their unique proposition in the marketplace, there will always be a gap that is underserved, and Google can take advantage of that. So at least in the recent earnings call, Sundar, who's the CEO of Google, is pumped up for the upcoming new model, Gemini, which would be their answer to the competition in the cloud space through harnessing next-gen AI capabilities. So I know, this entire AI hype, there's a lot of mumbo-jumbo, and I will only believe it when I see it in the numbers. But anyhow, if we were to pivot back to the advertising business, the biggest concern on most investors' minds today would be how the industry would be impacted in the foreseeable future. So advertising is a rather simple business that models after the health of the economy. So when times are good, ad dollars go up as companies are much more willing to spend. But when times are down, marketing purse strings tightens and we go through a dry spending period. So if we cross-reference this to a fellow advertising giant, who also happened to just report their earnings recently, the CFO, Chief Financial Officer of Meta Platforms, Susan Lee, actually warned that Q4 of 2023 and the whole of 2024 would be highly dependent on macro factors. And she said that Meta Platforms sees a pause in early Q4 ad spending due to the Israeli conflict. So in short, the advertising industry is sensitive to the macro environment, which begs the question, how badly did Meta do in the recent call that warranted a 4% drop post-earnings? If I can give you a quick hint, not only did they not do badly, it was spectacular. Revenue was up 23% year-on-year, cost was down 7%, income from operations gapped up 143%, and their operating margin doubled from 20% to 40%. Operating margin, by the way, it was simply amazing. So just 1 year ago, there were many naysayers proclaiming that Facebook is dead and it could no longer grow. Time flies, and you can see how quickly people change their minds and opinions. That said, I do have to acknowledge that there is a very strong correlation between Meta's free cash flow and their share price. So on many other business metrics, Meta has also performed superbly. Their daily and monthly active users are on a nice uptrend. They continue to repurchase shares, although at a much slower rate due to the recent rally of their share price. And more importantly, they cut their headcount meaningfully, which contributed to a huge reduction in their cost structure. However, there are probably two small negatives that you might want to monitor. First, although revenue growth came in extremely strong, it was contributed mainly by stuffing more advertisements on their platform to combat the reduction in ad prices. So ad impressions actually increased by 31% year-on-year, while prices per ad decreased by 6%. So personally, as a user of their core products, I do see much more advertisement being plastered my way that have caused some sort of annoyance occasionally. So it's true that Meta enjoys an extremely strong economic moat, namely the network effect. But there might come a potential breaking point down the line if they step overboard, and users might start migrating towards another decent contender in the space. And this competitor doesn't even need to be better than Facebook or Instagram. They just need to be so annoyed at Meta Platforms. Secondly, Reality Labs continues to be the disappointing child, like in every Asian family. So revenue actually fell 26% year-on-year, while the losses on the bottom line continued to climb. So like many fellow Meta shareholders, most of us have probably written off this part of the business. But I do feel like Meta is slightly too early into this entire metaverse AR/VR game. And they are paying the price to be a pioneer in an industry with no visibility. So the billions of dollars that they're burning over the years, it's a cost that we need to pay if we want a piece of Zuckerberg's pie. The cherry on the cake, Susan Lee actually guided Q4 revenue to be between 36.5 billion to 40 freaking billion US dollars. So even on the lower end, it's a 13.5% growth year-on-year. So this guidance actually includes the impact that they've seen from the reduce and pullback in ad spending due to the Middle Eastern conflict. So you might ask, if everything is so good, why is the stock still down? Most importantly, I think we need to acknowledge that some of these tech companies have grown to a size so huge that they no longer can just rely on the individual exceptionalism to excel, but require the major economies to progress alongside them. So when there are signs of slowdowns, recessions, conflicts arising, these advertising companies are going to be dragged down inevitably. So to me, I see this as the market trying to price in a less than optimistic scenario moving into 2024. Therefore, they're combing back the valuations of some of these companies by a little. So let's also not forget that both Meta and Alphabet had a great run in 2023, and the current pullback doesn't seem demanding at all in the grander scheme of things. So for retail investors like us, who really have a much longer time horizon compared to Wall Street, I do think that this might be an opportunity to continue adding if you want to have such exposure. On a side note, I've recently added to one of the two companies we have discussed here, and you can guess which one I added in the comment section down below. So if you guys are interested in any other company's earnings breakdown, do leave it in the comments below and I might do it next if there's enough interest. Tesla excluded. No, I'm just joking. You can of course include Tesla in the comments below. This is CK from Piranha Profits. Till next time, keep winning.